Before we begin, it's crucial to state that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only and should not be considered as financial or legal advice. The world of insurance is complex, and you should always consult with a qualified professional to discuss your individual situation and needs. The average driver in Illinois is set to overpay for their car insurance by $784 in 2026. Not because they're a bad driver, not because they have a bad car, but because the system is designed from the ground up to take advantage of one simple fact: you're busy. You have a life, a job, a family. You don't have time to spend 40 hours becoming an expert on bodily injury liability versus uninsured motorist coverage. And the insurance giants are counting on that. They thrive on confusion. They profit from inertia. They call it price optimization, which is a fancy corporate term for charging loyal customers more money just because they know you're not likely to shop around. It's a loyalty tax. And today, right here, you and I are going to make sure you never pay it again. This isn't just another video listing the top 5 cheapest insurance companies. That's a snapshot in time, and it's useless without context. This is your roadmap, your masterclass. Over the next several parts of this series, we are going to systematically dismantle the entire process of buying car insurance in the state of Illinois. We're going to expose the myths, decode the jargon, and build a personalized strategy that puts that $784 or more back in your pocket where it belongs. By the time we're done, you will understand exactly what 100/300/50 means and why the state minimum is a financial trap waiting to spring. You'll know the precise difference between collision and comprehensive, and when it makes sense to drop one of them entirely. You'll discover the one optional coverage that costs pennies, but can save you from bankruptcy. You will have a step-by-step negotiation script to use with your current provider and a checklist for comparing new quotes like a seasoned pro. This isn't about finding a cheap, flimsy policy. It's about finding the right policy at the best possible price. It's about building a fortress around your assets without lighting your money on fire. And why are we focusing so hard on 2026? Because the game is changing fast. The ripple effects of post-pandemic inflation are hitting the auto industry like a tidal wave. The cost to repair even a minor fender bender has skyrocketed due to supply chain issues and advanced technology in new cars, sensors, cameras, specialized materials. That means the cost for insurers to cover claims is exploding, and you can bet they are passing those costs directly onto you in the form of massive rate hikes. We're also seeing new regulations taking shape in Springfield and the aggressive rollout of telematics, those little apps or plug-in devices that track your every move behind the wheel. They're being sold as a way to save money, but they can just as easily be used to penalize you for driving patterns you didn't even know were being monitored. The old way of set it and forget it with your auto insurance is no longer just inefficient, it's financially reckless. 2026 is the year where being an informed consumer isn't just a good idea, it's an absolute necessity. Let me tell you about a guy named David from Schaumburg. David is the perfect customer. He's been with the same big-name insurance company for 12 years. Never had an at-fault accident, never even had a speeding ticket. Every 6 months his renewal notice would come in the mail, he'd see a small 3 or 4% increase and he'd just pay it. He figured, that's just inflation, right? The cost of doing business. He trusted the brand. He liked his agent, a nice guy named Bill who sent him a calendar every Christmas. What David didn't know was that for the past 5 years, his loyalty was being punished. His rate was creeping up far faster than his risk profile warranted. New customers with driving records far worse than his were being offered introductory teaser rates that were hundreds of dollars less than what David, the perfect 12-year customer, was paying. His insurance company was using the profit from his overpriced policy to subsidize the acquisition of new, riskier clients. David was paying a loyalty tax of nearly $600 a year. He only found out when his son, home from college, used a comparison tool just for fun and was absolutely floored by the results. David made one phone call, switched companies, got the exact same coverage from a top-rated competitor, and instantly saved over $1,000 on his annual premium for his 2 cars. His agent Bill never called to ask why he left. That story plays out thousands of times a day across Illinois. In Chicago, Peoria, Springfield, Champaign, good people, responsible drivers, are unknowingly subsidizing an entire industry because they believe the myth that loyalty is rewarded. It's not. In the modern insurance market, loyalty is monetized. Your complacency is their profit margin. So how do we fight back? With knowledge. We're going to turn you into the insurance company's worst nightmare. An educated consumer who knows exactly what they want and exactly what it's worth. We're not just going to scratch the surface. We will go deep. We'll talk about credit scores and how they impact your rates in Illinois, a practice that's controversial but perfectly legal. We'll discuss gap insurance and whether you actually need it, or if the dealership just sold you an expensive add-on. We'll even cover what to do after an accident to ensure your rates don't spiral out of control. This is a complete A to Z guide, specifically tailored for Illinois drivers heading into 2026. Forget everything you think you know. Forget the catchy jingles and the cartoon mascots. They are a distraction. The only thing that matters is the policy document, the contract you sign, and the price you pay for it. Our mission is to optimize both in your favor. So get ready. The first thing we need to do is understand the battlefield. Who are the major players in the Illinois insurance market? It's not just the handful of companies that spend billions on Super Bowl ads. There are regional powerhouses and lesser-known providers that offer incredible value, but don't have the marketing budget to get on your radar. Understanding these tiers of insurance companies is the foundational first step to unlocking massive savings. Because you can't win the game if you don't even know all the players on the field. Let's start by exposing the biggest lie the insurance industry tells every single one of its customers. The biggest lie is that loyalty pays. It's a marketing masterpiece, a carefully crafted piece of fiction whispered into our ears through every commercial, every renewal notice, every friendly call from our agent. The lie is that if you just stay put, if you're a good customer, your insurance company will reward you with the best rates. It feels true, doesn't it? It taps into our fundamental desire for stability and fairness. But in the cold, hard world of insurance algorithms, loyalty is often a liability. They call it price optimization, a fancy term for a simple, brutal practice, gradually increasing the premiums of loyal, long-term customers who are unlikely to shop around just to see what they can get away with. They are banking on your inertia. They are profiting from your trust. And in Illinois, this loyalty tax can cost you hundreds, even thousands of dollars a year. So why do we believe this lie? Because the alternative seems overwhelming. There are over 150 different auto insurance companies licensed to operate in the state of Illinois. 150. It's a staggering number designed to induce paralysis. You hear the same 5 or 6 names on TV and assume that's the entire market. But that's like thinking the only restaurants in Chicago are McDonald's and Burger King. The real value, the hidden gems, are found when you look beyond the blaring neon signs. To do that, you first need a map. You need to understand that all these companies fall into 4 distinct categories. Think of them as 4 different tribes, each with its own culture, its own strengths, and its own weaknesses. First, you have the giants. These are the household names, the titans of the industry. State Farm, headquartered right here in Bloomington, Illinois. Allstate, based in Northbrook. Then you have the national behemoths like Geico and Progressive. Their strength is their sheer size and brand recognition. They spend billions of dollars a year on advertising to make sure their name is the first one that pops into your head. They have vast networks of agents, massive call centers, and slick mobile apps. For many people, this provides a sense of security. There's a comfort in knowing you're with a company that has been around forever and has the resources to handle a major claim. But that size comes at a cost, and you're the one paying for it. Those celebrity endorsements and Super Bowl commercials aren't free. The giants often have higher overhead, which gets baked into your premium. They can also be slow to adapt, trapped in a bureaucratic web that makes getting a straight answer feel like a full-time job. They are the big box stores of the insurance world. Convenient, familiar, but rarely the place you find the best deal or the most personal service. For some drivers, especially those with complex needs or multiple policies, they can be a good fit. But for the average Illinois driver, assuming the giants are your only option is the first and most expensive mistake you can make. The second tribe is the digital disruptors. These are the new kids on the block, the tech-savvy upstarts like Lemonade, Root, and Metromile. They don't have brick-and-mortar offices or massive agent networks. Their storefront is your smartphone. Their entire business model is built on technology, data, and a direct-to-consumer approach. They promise a faster, easier, and more transparent experience. Instead of a 20-page application, you answer a few questions in an app. Instead of basing your rate on broad demographic data, they often use telematics, a program on your phone or a device in your car that tracks your actual driving habits. Are you a safe, low-mileage driver living in a Chicago suburb like Naperville and only using your car for weekend trips? A company like Root or Metromile could cut your bill in half compared to a traditional insurer. They reward good behavior in real time. The appeal is obvious: fairness. You pay for how you actually drive, not how a company thinks someone like you might drive. But there's a flip side. This is a double-edged sword. If you have a heavy foot, brake hard, or frequently drive late at night, that same technology will penalize you with higher rates. Furthermore, many of these companies are still relatively new. Their claims processes might not be as smooth or time-tested as the old guard. They are the trendy, direct-to-consumer online brands. You might get a fantastic, customized product for a great price, but the customer service experience can sometimes be a gamble. Now we move to the third tribe, and this is where it gets really interesting for Illinois residents: the regional champions. These are companies that may not have a massive national footprint, but they are powerhouses right here in the Midwest. Think of companies like Country Financial, another Bloomington-based insurer, or Pekin Insurance from Pekin, Illinois. Erie Insurance and auto owners are other major players in our state. These companies live and breathe Illinois. Their underwriters understand the specific risks of driving on I-90 during a snowstorm or navigating harvest season traffic downstate near Champaign. Because they don't spend billions on national advertising, they can pass those savings on to you. Their competitive advantage is deep local knowledge and, very often, superior customer service. When you call them, you're more likely to speak with someone who understands your community because they're part of it. They consistently rank at the top of J.D. Power customer satisfaction surveys for a reason. They build their business on reputation and relationships, not on catchy jingles. The potential downside? Their digital tools might not be as slick as the tech companies, and if you move out of their coverage area, you'll have to switch. But for long-term Illinois residents, ignoring the regional champions is like living in Chicago and never trying deep dish pizza. You are missing out on one of the best local specialties. Finally, we arrive at the fourth and most overlooked tribe: the hidden gems. These are often smaller mutual insurance companies. A mutual company is fundamentally different from a stock company like Allstate or Progressive. Stock companies are owned by their shareholders, and their primary legal duty is to maximize profit for those investors. Mutual companies, on the other hand, are owned by their policyholders. That's you. This isn't just a philosophical difference. It has a real-world financial impact. Since they don't have to answer to Wall Street, mutual companies can prioritize the interests of their members. This often translates into lower premiums, better service, and in some cases, even annual dividends paid back to you when the company has a profitable year. Companies like the Cincinnati Insurance Companies, or even smaller, more localized Illinois county mutuals, fall into this category. They rarely advertise. You won't see them on a billboard. You often have to find them through an independent insurance agent. They are the insurance world's equivalent of a secret, local farmer's market. You have to know where to look, but the quality and value you find there is often unmatched. They prove that the best deal isn't always the most heavily advertised one. In fact, it rarely is. So we have the giants, the digital disruptors, the regional champions, and the hidden gems. For distinct paths, each leading to a vastly different outcome for your wallet. Just knowing these categories exist shatters the illusion that your choices are limited. It transforms you from a passive consumer into an informed shopper. But knowing the players on the field is only the first step. The next, and arguably more critical step, is understanding the secret rulebook they all use to play the game. It's a rulebook filled with codes, scores, and factors that have nothing to do with your driving record, and they use it to decide exactly how much to charge you. And one of these factors is so powerful, it can change your premium by over 70%, even if you're a perfect driver. We're going to pull back the curtain on that next. That powerful factor, the one that can swing your insurance premium by 70% or more, has absolutely nothing to do with how you drive. It has nothing to do with your car, your commute, or whether you've ever had a single ticket in your life. It's your credit score. Yes, that 3-digit number that banks use to decide on mortgages and credit cards is one of the single most important factors that auto insurance companies in Illinois use to decide your rate. And to most people, this feels like a betrayal, a secret penalty. You think you're being rated on your driving, but you're actually being judged on your finances. Let me paint a picture for you. Imagine two identical twins. We'll call them Sarah and Jessica. They both live in Springfield, Illinois. They both drive identical 2023 Toyota RAV4S. They're the same age, have the same job, and most importantly, they both have a completely spotless driving record. Not a single accident, not a single ticket. Ever. By every measure of driving skill and safety, they are identical risks. But there's one difference. Sarah, a few years back, went through a messy divorce and a medical emergency that tanked her credit score. It's currently sitting around 560, which is considered poor. Jessica, on the other hand, has been diligent with her finances, and her credit score is an excellent 790. When they both call the exact same insurance company for a quote, Sarah is quoted a premium of $2,200 a year. Jessica is quoted $1,250. That is a $950 difference. A 76% penalty for Sarah, for something that has nothing to do with her ability to safely operate a vehicle. This isn't a hypothetical scare tactic. This is the reality of auto insurance pricing in Illinois in 2024, and it's a trend we expect to see continue and even intensify into 2026. So why on earth do they do this? If you ask the insurance companies, they won't say they're punishing people for being poor. They'll give you a very calm, data-driven answer. Their actuaries, the mathematicians who calculate risk, have found a statistical correlation. Decades of data, they claim, show that people with lower credit scores on average file more claims than people with higher credit scores. They're not saying you're a bad driver. They're saying that as a group, people with your financial profile are more likely to cost them money. It's a cold, hard statistical calculation. They've determined that financial responsibility is a predictor of future insurance losses. But this is where a massive debate erupts. Critics, consumer advocates, and a growing number of lawmakers argue that this practice is fundamentally unfair. It disproportionately penalizes lower-income individuals, minorities, and people who have suffered unpredictable life events, just like our example, Sarah. A single major medical bill, a job loss, a divorce. Any of these can devastate a credit score, and suddenly your car insurance, a necessity for getting to work and living your life, becomes punishingly expensive. It creates a cycle where financial hardship leads to higher insurance costs, which in turn creates more financial hardship. Some states, like California, Hawaii, and Massachusetts, have actually banned the use of credit scores in setting auto insurance rates. But in Illinois, it is perfectly legal and widely practiced. So let's break down exactly how this works. Insurers typically group credit scores into tiers. While the exact numbers vary by company, it generally looks something like this. Excellent credit, usually a FICO score above 780. Good credit, from about 670 to 779. Average or fair credit, from 580 to 669. And poor credit, anything below 580. The difference in premiums between these tiers is staggering. In Illinois, a driver with a perfect record but poor credit can expect to pay, on average, between 70 and 100% more than an identical driver with excellent credit. That's the difference between paying $100 a month and paying $200 a month for the exact same coverage. Now, to be technically precise, insurers don't usually use your regular FICO or Vantage score that you see on Credit Karma. They use something called a credit-based insurance score. It's a special version of your credit score, tailored for the insurance industry. It's calculated using information from your credit report, but it gives more weight to certain factors. The biggest one by far is your payment history. Do you pay your bills on time? This accounts for about 40% of your score. The second is your credit utilization and outstanding debt. How much do you owe? And how much of your available credit are you using? This is about 30% of the score. Then comes the length of your credit history. Older accounts are better, followed by the mix of credit you have, like credit cards, a mortgage, and an auto loan, and finally any recent applications for new credit. What's not supposed to be in your credit-based insurance score? Your income, your race, your religion, your gender, your marital status, or where you live. Those factors are explicitly excluded from the credit report itself. However, as we'll see later, some of those things, like your zip code and marital status, are used as entirely separate factors to calculate your premium. So the big question is, what can you do about it? If your credit isn't where you want it to be, you are not powerless. Improving your credit score is one of the most effective ways to lower your insurance premium over the long term, and the steps are straightforward. First, and this is non-negotiable, pay every single bill on time. Set up autopay for at least the minimum payments so you never miss a due date. One late payment can stick on your report for 7 years. Second, aggressively pay down your credit card balances. Your goal is to get your credit utilization ratio. That's your balance divided by your credit limit, below 30% on all your cards. If you have a card with a $5,000 limit, try to keep the balance below $1,500. Third, don't close old credit cards. A longer credit history is a better credit history. Even if you don't use an old card, keep it open, maybe use it for a small recurring payment you can pay off immediately just to keep it active. Fourth, be strategic about applying for new credit. Every time you apply, it can cause a small temporary dip in your score. Avoid opening a bunch of new accounts in a short period. And finally, the most important step you can take today. Check your credit report for errors. You are legally entitled to a free copy of your report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, once a year. Go to the official government-mandated site, annualcreditreport.com. Comb through it. If you see an account that isn't yours or a late payment that you know you paid on time, dispute it immediately. Fixing a single error can sometimes boost your score by dozens of points. But what if you need affordable insurance right now, and your credit needs a year or 2 to recover? This is where shopping around becomes your superpower. Not all insurance companies weigh credit the same way. Some are far more forgiving than others. Newer, data-driven companies might rely on it heavily, while some older, more traditional insurers might place more emphasis on your driving record. There are also companies that specifically market to drivers with less than perfect credit. The only way to find out is to get quotes. Get at least 5. Be honest about your situation, and specifically ask the agent if they have programs or discounts that can help offset a lower credit-based insurance score. It's a frustrating reality that your financial past can dictate the cost of your driving future. But by understanding how the system works, and by taking proactive steps to manage your credit, you can take back control and stop overpaying. This is one of the most significant ways to slash your bill, but it's far from the only hidden factor at play. Insurers look at a whole host of things that have nothing to do with your driving or your credit. In fact, one of them is so sensitive it can cause your rate to double just by moving across the street. And another can give you an instant 20% discount just for changing your relationship status. We're diving into the geography of your insurance bill next. It sounds unbelievable, doesn't it? That the invisible line separating one postal code from another can act like a financial wall. But in the world of auto insurance, your address is more than just where you get your mail. It's a complex data point that tells a story about risk. And insurers are obsessed with that story. Let's start with the big picture. Illinois is not one single, uniform state in the eyes of an insurance company. It's a patchwork quilt of thousands of distinct territories, each with its own risk profile. The most dramatic split, of course, is between the Chicagoland area and everywhere else. A driver with a perfect record, driving the exact same 2024 Toyota Camry, could easily pay double, sometimes even triple, living in downtown Chicago compared to living in Springfield or Peoria. Why? It's a simple game of numbers. In a densely populated urban center, you have millions of cars crammed into a small space. More cars mean more chances for collisions, more traffic, more fender benders, more stop-and-go wear and tear. The sheer probability of an accident skyrockets. But it gets far more granular than just city versus country. Insurers drill down to your specific 9-digit zip code. They buy massive amounts of data tied to these tiny geographic areas. They know the frequency of accidents at the intersections you drive through every day. They know the rate of vehicle theft and vandalism on your block. They analyze weather data, knowing that certain areas are more prone to destructive hail that leads to a flood of comprehensive claims, while others might be in low-lying zones susceptible to flooding that can total a car overnight. Think about it from their perspective. They are actuaries, professional risk assessors. If their data shows that zip code 60657 in Chicago's Lakeview neighborhood has a 12% higher rate of reported collisions and a 20% higher rate of auto theft than zip code 60540 in suburban Naperville, they are going to charge every single person in Lakeview a higher base rate to compensate for that elevated risk. It doesn't matter if you are the safest driver in the world, have never had a ticket, and keep your car in a locked private garage. You are paying a geography tax based on the collective behavior and circumstances of your neighbors. You are, in a sense, subsidizing the risk of living where you live. This is where the moving across the street scenario becomes a reality. Major roads often serve as dividing lines between zip codes or insurance territories. Let's imagine you live in an apartment on the north side of Division Street in Chicago. Your insurer might have that entire area flagged as a moderate risk zone. But just across the street, on the south side of Division, a new zip code begins. And maybe historically, that specific zip code has a higher concentration of claims for break-ins, more reported hit-and-runs, and more uninsured motorist claims. The moment you tell your insurance company you moved from apartment 1A on the north side to apartment 2B on the south side, their system flags the change. Your profile is instantly recalculated. Your premium could jump by hundreds of dollars a year, even though your daily commute, your driving habits, and your car haven't changed at all. You're the same driver, but in their eyes, you've moved into a statistically more dangerous world. The inverse is also true. Moving from a high-cost urban area to a quieter suburb or a rural town can feel like getting a massive raise. The savings on your auto insurance alone can be staggering, sometimes dropping by 40 or 50%. This is a powerful, often overlooked financial consideration when you're thinking about relocating within the state. Before you sign a lease or make an offer on a house, get an auto insurance quote for that new address. It is a real, recurring monthly expense that should be factored into your budget, just like property taxes or utility bills. A $500 difference in annual premiums between two houses you're considering is a significant factor. And this isn't just about accidents and crime. It's also about the cost of fixing things. Insurers track the average cost of vehicle repairs by territory. Labor rates for mechanics in Cook County are generally higher than in Macon County. The cost of towing, parts, and storage can vary. Even the social and legal climate of a region plays a part. Some counties have a reputation for being more litigious, meaning people are more likely to hire a lawyer and sue after an accident, leading to larger payouts for bodily injury claims. The insurers track all of this. They know which court systems tend to favor plaintiffs and award larger settlements, and they price that risk directly into the premiums for everyone living in that judicial district. So what can you do? You can't exactly change the statistics of your neighborhood, but you can be strategic. First, as we said, always get a quote before you move. It's free and takes 5 minutes online. Second, be specific about your parking situation. If you have a secure off-street garage, make absolutely sure your insurer knows that. In a high-theft zip code, a garaged car is a much lower risk than one parked on the street, and it can lead to a tangible discount. Third, if you live on the border of a territory, it might be worth getting quotes using a friend's or family member's address in a neighboring cheaper zip code, just to understand the financial impact of that invisible line. Obviously, you must use your actual garaging address for your policy, but this research can arm you with knowledge about how much your location is truly costing you. The geography of your insurance bill is a fascinating and often frustrating look at how data, not just your driving, determines your costs. It's a story about the collective risk of a place being assigned to you as an individual, but the place you live is only one part of the personal profile they build. Insurers dig even deeper into your life, looking at factors that feel intensely private and have absolutely zero to do with your ability to operate a vehicle. One of the most powerful and most controversial of these factors is your marital status. Getting married can, in an instant, make you seem like a safer bet, slashing your premiums without you ever touching the steering wheel. But a divorce? That can send your rate soaring right when you can least afford it. The surprising and frankly kind of judgmental ways that your love life impacts your insurance bill is what we're untangling next. It's a brutal irony. The insurance company doesn't care if you're the safest driver in all of Cook County, but they become intensely interested the moment you change your relationship status on Facebook. So why does your love life, or lack thereof, matter so much to a car insurance underwriter? The answer, like everything in insurance, comes down to one word: statistics. Decades of data, compiled from millions of drivers, have shown insurers a correlation that's almost impossible for them to ignore. Married people, on average, file fewer and less expensive claims than single people. Now let's be crystal clear. This doesn't mean your marriage certificate magically installs a better braking system in your brain. It doesn't mean single people are all reckless daredevils. It's a correlation, not a causation. The industry's theory is that marriage is often associated with a more stable, risk-averse lifestyle. Maybe you have kids in the back seat so you're driving slower. Maybe you're saving for a mortgage so you're not out late at night. Whatever the reason, the numbers are the numbers, and in the world of insurance, numbers are king. Married drivers are seen as a safer bet, a more predictable risk, and in Illinois, using marital status to calculate your premium is perfectly legal. So when a divorce happens, the algorithm sees it not as a painful life event, but as a change in your risk profile. And it triggers what I call the insurance divorce penalty, which is often a devastating triple whammy. First, and most obviously, you lose the married rate. You are now recategorized as a single driver, and that alone can bump up your premium by 5, 10, even 20% or more, depending on your age and other factors. You've gone from being part of the statistically safe group to the statistically riskier one, overnight, without ever getting a single ticket. The second hit is the loss of discounts. This one is huge. Most married couples have their policies bundled together. You get a multi-car discount for insuring both vehicles with the same company. You probably have a multi-policy or bundling discount for having your home or renter's insurance with them too. When you get divorced, that entire house of cards comes tumbling down. Suddenly, you have to uncouple your policies. You're now insuring one car instead of two. You're moving into an apartment and need a new renter's policy, breaking the home and auto bundle. Each one of those discounts vanishes into thin air. I've seen cases where the loss of these discounts alone doubled a person's premium. It's a massive financial blow at the worst possible time. The third whammy is more subtle, but just as damaging: geography and credit. During a divorce, at least one person moves. If you're the one who moves from a quiet suburban house in Naperville to a new apartment in a denser part of Chicago, your zip code just changed. And as we've discussed, your zip code is a monster factor in your rates. Insurers see more cars, more traffic, more street parking, more potential for theft and accidents, and they jack up the price accordingly. On top of that, divorce can be a financial wrecking ball. Legal fees, splitting assets, setting up a new household, it can wreak havoc on your credit score. And since Illinois insurers heavily rely on your credit-based insurance score to determine your rates, a dip in your credit can lead to another painful spike in your premium. So you get hit for being single, hit for losing your discounts, and potentially hit again for your new address and a damaged credit score. It's a perfect storm of rate increases. On the flip side, of course, is the marriage bonus. Getting married, especially when you're under 25, is one of the single biggest things you can do to lower your car insurance rate. For young drivers, particularly young men, the statistical drop-off in risk when they get married is so significant that the discount can be enormous. It's the insurance company's way of saying, okay, our data suggests you're probably going to calm down now. It's also when you get to start stacking those discounts we just talked about. You can combine your two separate, expensive policies into one cheaper multi-car policy. You can bundle it with your new renter's insurance. You immediately look like a better, more stable customer in the eyes of the algorithm. But what if you're single by choice? What if you've never been married and have no plans to be? It can feel incredibly unfair, like you're being penalized for your lifestyle. And in a way you are. You're paying what some call a singles tax. You're automatically placed in a higher risk demographic pool, even if your personal driving record is flawless. Feels personal, but you have to remember, to the insurance company, it's just math. They aren't making a moral judgment. They are making a financial calculation based on the aggregated behavior of millions of people you've never met. So if you're a single driver in Illinois, what can you do to fight back against this statistical bias? Your strategy has to be to prove to the algorithm that you, as an individual, are a better risk than your demographic suggests. This is where telematics programs, the little plug-in devices or smartphone apps that track your actual driving habits, can be your secret weapon. By proving you brake smoothly, accelerate gently, and don't drive late at night, you are providing the insurer with data that is specific to you, not your marital status. This can counteract the single driver penalty. You also need to be an aggressive shopper. Some companies weigh marital status more heavily than others. The only way to find out which one will give you the best deal is to get quotes from everyone. And I mean everyone. The big national players, the smaller regional Illinois-based mutual companies, everyone. Finally, max out every other possible discount. Good student, defensive driving courses, professional affiliations, low mileage discounts if you work from home. You have to claw back the savings that married couples get automatically. You have to build your own bundle of discounts to offset the one you're not eligible for. It's more work, but it's the only way to level the playing field. The system may have a built-in bias, but it's not unbeatable. You just have to be a smarter, more proactive consumer. Your love life is under the microscope. But what about your report card from college? Or the title on your business card? You might think your job as an accountant has nothing to do with how you drive your minivan on the weekends, but your insurance company would strongly and expensively disagree. We'll break down the bizarre world of how your career and education can either save you a fortune or cost you one, next. It all comes down to a single word: statistics. Your insurance company doesn't know you. They don't know if you're a responsible, cautious person who just happens to be a bartender, or a reckless maniac who happens to be a tenured professor. They can't know that. So instead, they play a game of massive-scale pattern recognition. They employ armies of actuaries, Think of them as the data science wizards of the financial world, who sift through mountains of claims data from millions of people over decades. And their one and only job is to find correlations. They're looking for any trait, any characteristic, any variable at all that, when you look at a million people, predicts a lower or higher likelihood of filing a claim. It's not about causation, it's about correlation. They're not saying your PhD causes you to be a better driver. They're saying that the data shows the group of people with PhDs, as a whole, costs them less money than the group of people without them. Feels deeply personal and frankly deeply unfair. But to them, you're not a person. You're a collection of data points, and your profession and education level are two of the most powerful data points they have. Let's pull back the curtain on who gets the best rates. Insurers have what you could call a golden list of professions. These are the jobs that their data screens are occupied by safe, low-risk drivers. At the top of this list, you'll almost always find engineers, scientists, and teachers. Why? The actuarial logic goes something like this. Engineers and scientists are perceived as being methodical, detail-oriented, and risk-averse by nature. They build bridges and analyze complex systems. The thinking is that this cautious, analytical mindset extends to how they operate a 2-ton vehicle. Teachers are seen as responsible, community-minded individuals who often have structured schedules, meaning they may be less likely to be on the road during high-risk late-night hours. Another surprise winner? Pilots. The rationale here is obvious. They are professionals trained to an elite level in risk management, procedure, and situational awareness. That skill set, insurers bet, doesn't just switch off when they get into a car. You'll also see nurses, accountants, and even librarians getting favorable rates. Nurses witness the horrific results of car accidents firsthand, potentially making them more defensive drivers. Accountants are stereotyped as cautious and by the book. It's a game of proxies. Your job title becomes a proxy for a personality type that is less likely to cost the insurance company money. Now, on the other side of the coin, there are professions that raise red flags in the actuarial tables. If you're in outside sales, for instance, you're likely to see higher premiums. It's nothing personal against your character. It's a simple equation: you drive for a living, more miles on the road, often in unfamiliar areas and under pressure to make appointments, equals a statistically higher chance of an incident. The same goes for any kind of delivery or courier driver. You are, by definition, a high-exposure risk. Construction workers can also face higher rates. They often drive larger trucks, haul equipment, and travel to various job sites, which the data might show leads to more claims. And then there are the jobs with non-traditional hours. Restaurant workers like chefs, servers, and bartenders often drive home late at night when roads are more dangerous due to fatigue and a higher prevalence of impaired drivers. But perhaps the most fascinating one is attorneys. You might think a lawyer would be the most by-the-book driver on the planet. And you might be right. But some insurers give them higher rates for a different, more cynical reason. They are statistically far more likely to understand the claims process and to litigate if they feel an offer is too low. A minor fender bender that might be a simple $5,000 repair for a teacher could turn into a $50,000 affair involving legal battles with an attorney. They represent a higher financial risk to the insurer, not because of their driving, but because of their profession itself. This statistical profiling extends directly to your education. The data is incredibly clear on this point. The higher your level of formal education, the lower your insurance rates tend to be. Someone with a PhD will, on average, pay less than someone with a master's, who will pay less than someone with a bachelor's, who will pay less than someone with a high school diploma. Again, the insurer isn't saying a college degree magically infuses you with better driving skills. They're saying that their historical data shows a powerful correlation between educational attainment and filing fewer, less expensive claims. The reasons are likely complex and socioeconomic. Perhaps it correlates with living in safer neighborhoods with less traffic, having more stable jobs with regular hours, or driving newer, safer cars. The exact why doesn't matter to the insurance company. All that matters is that the correlation is strong enough to bet their money on. This is why you see specific discounts that piggyback on this idea, like the good student discount for high school and college kids with a B average or better. The logic is that a responsible student is likely to be a responsible driver. It's also why many insurers offer affinity discounts through university alumni associations. They want to attract a pool of college-educated drivers they know will be profitable in the long run. So, what can you actually do with this strange, unsettling information? This is where you can play their game to your advantage. First, be incredibly mindful of your job title when you get a quote. You must be honest, but you also have leeway. For example, If you're a manager in a sales department, but you work from a desk all day, calling yourself a marketing manager instead of an outside sales representative could make a huge difference. The first sounds like a stable, office-based job. The second sounds like someone who lives on the highway. If you're a chef versus a restaurant worker, one implies a stable, skilled professional, while the other is more ambiguous. Talk to your agent. Tell them what you do and ask them to check the rates for a few different but still accurate job titles. You might be shocked at the difference a single word makes. Second, never ever omit your education. If you got a bachelor's degree 30 years ago, it still counts. Make sure it's on your policy. If your child is in college and has the grades, get them the good student discount. Don't leave that money on the table. Third, actively hunt for group and affinity discounts. Are you a member of a professional organization like the Illinois Education Association or the American Nurses Association? Did you graduate from the University of Illinois? Are you a veteran or active military? Do you work for a large corporation? All of these groups often negotiate bulk discounts with major carriers that can save you 5, 10, or even 15%. Now, looking toward 2026, it's important to understand that this entire practice is becoming increasingly controversial. States like California, Massachusetts, and Michigan have already banned or severely limited the use of occupation and education levels in setting car insurance rates. The argument against it is powerful. It's a form of economic redlining. It penalizes hardworking people in blue-collar jobs, or those who, for whatever reason, didn't pursue higher education. It essentially charges people more for being less wealthy, using their job as a proxy for their income level, without ever considering their actual driving record. As of today in Illinois, it is still a perfectly legal and very significant rating factor. But the conversation is changing nationwide. It is entirely possible that by 2026, legislation could be introduced in Springfield to change these rules. This is a space to watch very closely, because the removal of these factors would fundamentally scramble the rate structures for millions of drivers across the state. So we've established that your diploma and your job title can have a bigger impact on your rates than a speeding ticket. But what if I told you that simply moving 2 blocks, from one side of the street to the other, could cut your insurance bill in half, or double it? Next, we're diving into the single most powerful factor in your auto insurance premium: your zip code. It's a concept that feels fundamentally unfair. You can be the safest driver in the world with a spotless record, a perfect credit score, and a car that's basically a 5-star safety-rated tank. But because of a line on a map, a line you probably can't even see, you could be forced to pay hundreds, even thousands of dollars more per year than someone just down the road. This isn't a hypothetical. This is the reality of auto insurance in Illinois and across the country. Your 5-digit zip code is a proxy, a statistical shorthand that tells an insurance company everything it thinks it needs to know about the risks your car faces when you're not even in it. So, let's break down exactly what these companies are looking at when they see your address. It boils down to 3 main categories of risk: crime, crashes, and costs. First, crime. They pull hyperlocal data on the frequency of vehicle theft and vandalism claims. If you live in a zip code where cars are stolen or broken into more often, their algorithm flags you as a higher risk for a comprehensive claim. It doesn't matter if your specific block is perfectly safe, or if you park in a locked garage. You are statistically bucketed with the entire zip code. A neighborhood in Chicago's Englewood, for example, might have a vehicle theft rate 10 times higher than a quiet subdivision in Schaumburg. That difference is priced directly into your premium before they even ask what kind of car you drive. Second, and even more significantly, is crashes. Insurers analyze the sheer density of traffic, the number of accidents per mile of road, and the severity of those accidents within your zip code. Are you in an area with complex, multi-lane intersections known for fender benders? Is your neighborhood full of narrow streets with cars parked on both sides, leading to more sideswipes? Do you live right off a major highway like the I-90 or I-294, where high-speed collisions are more common? They look at all of it. A driver in a dense urban area in Chicago is statistically more likely to be involved in an accident than a driver in a rural area near Carbondale, simply due to the number of other vehicles they encounter every single day. More cars equals more opportunities for collision. It's a brutal numbers game. Third, and this is the one most people never think about, is costs. This includes both litigation and repair costs. Some geographic areas are known to be more litigious than others. In certain counties, people are statistically more likely to hire a lawyer and sue for damages after an accident, even a minor one. This drives up the potential payout for bodily injury liability claims and insurers price that risk in. Furthermore, the cost to repair a vehicle isn't uniform across the state. The hourly labor rate for a body shop in downtown Chicago or a wealthy North Shore suburb like Winnetka is going to be significantly higher than the rate for a shop in Peoria or Rockford. The cost of parts, towing, and storage also varies. So, if you get into an identical accident, the claim will cost the insurance company more to settle if you live in a high-cost area. And that potential cost is, you guessed it, reflected in your premium. Let's make this real with some Illinois examples. Imagine two identical drivers. Both are 40 years old, perfect driving records, same car, same coverage. Driver A lives in the 60609 zip code, which covers parts of neighborhoods like Englewood and back of the yards in Chicago. This area, historically, has faced challenges with higher rates of crime and traffic density. Driver B lives in the 61820 zip code in Champaign, a college town with a mix of urban and suburban environments. Driver A might receive a quote for $2,500 per year. Driver B, for the exact same coverage, might be quoted $1,300. That's a $1,200 difference based on nothing but their address. But it gets even more granular and frankly more absurd. You don't even need to compare Chicago to downstate. Let's look within the suburbs. Take Naperville, often cited as one of the safest cities in America. But the 60563 zip code on the north side is bordered by the I-88 tollway and dense commercial corridors. The 60540 zip code, just to the south, is more residential with quieter streets. It is entirely possible for someone in 60563 to pay 15 to 20% more than their identical counterpart just a few miles south, simply because of the perceived risk from the nearby highway and shopping centers. This is the 2 blocks away scenario I mentioned. Sometimes the dividing line between zip codes is a single street. Your neighbor across the road could literally be in a different insurance rating territory and paying a completely different price. This practice has a name, and it's incredibly controversial. It's often called territorial rating, but critics have a stronger term for it: zip code redlining. The term redlining has a dark history, referring to the discriminatory practice of denying services, like mortgages, to residents of certain areas based on their racial or ethnic composition. The argument here is that using zip codes as a primary rating factor is a modern-day proxy for discrimination. Critics point out that historically marginalized and lower-income communities are often concentrated in dense, urban zip codes that, for a variety of complex socioeconomic reasons, also have higher rates of crime and traffic. So, a perfectly safe driver who happens to live in one of these communities gets penalized. They are charged more not because of who they are or how they drive, but because of where they can afford to live. They end up subsidizing the risks of their entire neighborhood. The insurance industry pushes back, of course. Their defense is that this isn't about discrimination. It's about actuarial science. They argue they are not pricing based on the race or income of the residents, but on the verifiable location-based data of claims. They say that ignoring the statistical risk associated with a specific territory would be irresponsible and would force drivers in safer, lower-cost areas to subsidize the higher claims from riskier areas. The state of Illinois currently allows this practice. While there have been pushes for reform from consumer advocacy groups, as of now, your zip code remains one of the most heavily weighted factors in your premium. So, what on earth are you supposed to do about this? You can't just pick up and move to a cheaper zip code. For 99% of us, our home is our home. The first step is awareness. Understanding that your location is a massive part of your bill helps demystify the process. When you get a shockingly high quote, you now know it might have less to do with you and more to do with your neighborhood statistics. This is also a critical piece of information if you're ever planning a move. Before you sign that lease or mortgage, get a few auto insurance quotes for the new address. That cheaper apartment one town over might come with a $600 a year insurance hike that completely wipes out your savings. You also need to be scrupulously honest about your garaging address. This is the legal term for the primary location where you keep your vehicle overnight. Some people are tempted to use a parent's address in a cheaper suburb or a P.O. box to get a lower rate. Do not do this. This is considered material misrepresentation, which is a form of insurance fraud. If you get into an accident and the company discovers you lied about your address, they have the right to deny your claim entirely, leaving you on the hook for tens or even hundreds of thousands of dollars, and they will cancel your policy. The risk is absolutely not worth the reward. The most powerful takeaway is this. Since you likely can't change this one massive factor, You have to be absolutely ruthless about optimizing every single factor you can control. You have to nail your credit, maintain a perfect driving record, and choose your vehicle wisely. But there's another level to this game. A level most people don't even know exists. So if you're stuck in a high-cost zip code, are you just doomed to pay high premiums forever? Absolutely not. In fact, there's a hidden list of over 20 discounts that almost nobody knows to ask for. Your agent won't volunteer them, and the website hides them deep in the fine print. Next, we're exposing that list one by one. Alright, let's pull back the curtain. The first category of hidden discounts are all about you, the driver. Insurance companies call this your risk profile. I call it a gold mine. First up, the good student discount. Now, you've probably heard of this, but you probably think it's just for high schoolers with a straight A report card. Wrong. This discount often applies to full-time college students up to age 25. The requirement is usually just AB average, or a 3.0 GPA. If your child is in college, you need to be sending a copy of their transcript to your insurance agent every single semester. It can slash the premium for that young driver by up to 25%. That's not pocket change, that's hundreds of dollars a year. But what if your student goes to college more than 100 miles away and doesn't take a car with them? That's a different, even bigger discount called the student away from home or distant student discount. Think about it. The riskiest driver on your policy is suddenly not driving your car for 9 months of the year. The risk plummets. This can cut their portion of the premium in half, but it only kicks in if you call and tell them. They'll still be covered when they come home for breaks, but you get a massive break the rest of the year. Next, for the adults, the defensive driving course discount. In Illinois, completing an approved defensive driving course can knock 5 to 10% off your premium for 3 solid years. People hear course and they tune out. They picture a stuffy classroom on a Saturday. But today you can do most of these online in a few hours for about 20 or 30 bucks. You spend $30 once and you get a recurring discount for 3 years straight. The return on investment is astronomical. You are literally buying a discount. Then there's the big one. The good driver or safe driver discount. Again, you've heard of it. But what does it mean? It's not just about not having accidents. Most top-tier safe driver discounts require a clean record for 5 years. That means no at-fault accidents, no DUIs, no major moving violations. But here's the secret. Sometimes a single speeding ticket can knock you out of this category. If you get a ticket, you should seriously consider fighting it or taking traffic school to get it expunged from your record. The cost of a lawyer or the class is often far less than the 5 years of higher premiums you'll pay from losing that safe driver status. Now for a discount that's criminally underutilized, affinity and occupational discounts. This is the one that really shows how deep the rabbit hole goes. Are you a teacher? There's a discount for that. A nurse? A firefighter? A police officer? A scientist? An engineer? Yes, all of them. Insurance companies have mountains of data, and their data says people in these professions are statistically safer drivers. They are less of a risk, so they get a better price. But it goes even further. Are you a member of a college alumni association? A fraternity or sorority? A credit union? A professional organization like the American Bar Association? What about wholesale clubs like Costco? All of these groups often have partnership deals with major insurers that give you a special rate nobody else gets. You must ask your agent, do you have a discount for engineers? Or, do you have a discount for University of Illinois alumni? They will not check for you. Let's move on to the second category. Discounts based on your CAR. The most obvious is the anti-theft device discount. If you have an alarm, you might get a small discount. But if you have a passive immobilizer, the kind that's built into your key fob so the car won't start without it, that's a bigger discount. If you have a vehicle recovery system like LoJack, that's an even bigger discount. In a place like Cook County, where auto theft rates are a serious concern, this discount can be substantial. Even something as simple and cheap as VIN etching, getting your vehicle identification number engraved on your windows, can qualify for a small discount with some carriers. Then you have all the safety feature discounts. Anti-lock brakes, airbags, automatic seatbelts, daytime running lights. Most modern cars have these as standard features. So you'd assume the discount is automatically applied, right? You would be wrong. It is shocking how often this gets missed, especially if you switch insurance companies. They might input your car's make and model, but their system might not automatically populate all the safety features. You need to explicitly say, my car has front and side impact airbags, anti-lock brakes, and daytime running lights. Am I getting the maximum discount for all of them? It's your money. Driving a newer car? If your vehicle is less than 3 years old, you should be getting a new car discount. The logic is that newer cars have more advanced safety features and are less likely to have mechanical failures that could lead to an accident. This one usually phases out after the car turns 3, but for those first few years it's a nice little bonus. And in the spirit of 2026, there's the green vehicle or hybrid discount. Insurers want to encourage eco-friendly behavior, and their data also suggests that hybrid and EV owners are often more meticulous, careful drivers. If you're driving a Prius, a Tesla, or a Chevy Bolt, you are leaving money on the table if you're not getting a 5 to 10% discount just for that. Okay, Category 3. Discounts based on your policy itself. This is about how you buy and manage your insurance. Everyone knows about bundling, the multi-policy discount. Combining your home and auto is the classic example. But don't stop there. Do you have a renter's insurance policy? Bundle it. A life insurance policy? Bundle it. A personal umbrella policy? Bundle it. The more policies you stack with one company, the deeper the discount on each one becomes. Similarly, the multi-car discount. Insuring more than one car with the same company saves you money. But here's the pro tip. If you have a daily driver and say a classic car or a convertible you only drive on weekends, make sure it's classified correctly on the policy. It should be listed as a pleasure or limited use vehicle, which will have a much lower base rate before the multi-car discount is even applied. Now, one of my favorites because it's pure math, the paid in full discount. Most people pay their insurance monthly. Feels more manageable, but insurers charge you for that convenience. They add a service fee of anywhere from $3 to $10 to every single payment. Pay for your 6-month or 1-year policy all at once, and not only do those fees disappear, but they will often give you an additional discount of 5 to 10% on top of that. Do the math. The effective annual return you get on your money by paying in full is often better than you can get in a high-yield savings account. And the two easiest discounts on the planet, the paperless discount and the auto-pay discount. You get a discount for getting your bills via email. You get another discount for having the payment automatically deducted from your bank account. Each one might only be a few bucks a month, but it's literally free money for clicking 2 buttons on their website. It's a no-brainer. Here's one people stumble into by accident: the early signing discount. If your policy is up for renewal on, say, June 1st, and you get your renewal offer in May, don't wait until May 31st to approve it. If you sign and approve the renewal at least 7 to 10 days before the deadline, many companies will give you a small discount for being proactive. Why? Because it saves them the administrative headache and cost of chasing you down. Finally, there's the loyalty discount. If you've been with the same company for 3 years, 5 years, 10 years, you should be getting a discount. But I'm giving you this one with a huge warning. Loyalty is a double-edged sword. While they might give you a small discount for staying, many insurers also practice something called price optimization. It's a fancy term for slowly raising your rates year after year, betting that you're too loyal or too lazy to shop around. So, while you should always ask for a loyalty discount, it should never stop you from comparing prices every single year. That brings us to our last category, the hidden life stage discounts, the low mileage discount. This became a massive deal after 2020 when so many people in Illinois started working from home. If you drive less than about 7,500 miles a year, you are a much lower risk. You need to tell your insurer this. They may ask for an odometer reading once a year, or they may offer you a telematics device, one of those little plugins that tracks your driving. If you are a safe, low-mileage driver, those telematics programs can lead to discounts of up to 40%. But even if you don't want to be tracked, you can still get a standard low-mileage discount just by self-reporting. And now, for what I think is the most powerful secret discount on this entire list, the homeowner discount. This is not the same as bundling your home insurance. This is a discount on your auto insurance simply for the fact that you own a home, a condo, or a townhouse. It doesn't matter if your home insurance is with a completely different company. Their data shows that people who own their homes are more stable and financially responsible, and therefore, they are safer drivers. This is a huge discount, often 10 to 20%, and an incredible number of agents forget to apply it. You have to ask, I own my home. Am I receiving the homeowner discount on my auto policy? There they are. Over 20 different ways to lower your bill that were always there, waiting just beneath the surface. It's not about finding the one magic bullet. It's about stacking 5, 6, 7 of these small discounts on top of each other until your premium is a fraction of what it was. But now you have the list, and that creates a new, very real problem. How exactly do you call your agent and ask for these without getting the runaround? What specific words do you use? What do you do when they say, "Sorry, you can't combine the Safe Driver discount with the Affinity Group discount"? There's a strategy for this. A 4-step negotiation framework that ensures you get every single dollar you deserve. And that is exactly what we are breaking down next. First, let's be clear. Walking into a negotiation with your insurance company unarmed is like walking into a Chicago winter without a coat. You're going to get cold fast. The framework we're about to build is your coat, your hat, and your insulated boots. It's a 4-step system designed to put the power back in your hands. Step 1 is what I call the dossier. This is your prep work. This is where you win the battle before you even pick up the phone. You're going to build a file, a dossier of irrefutable evidence. First, print out your current policy's declaration page. You need to know your exact coverage limits, your deductibles, everything. Don't guess. No. Second, you list every single potential discount we've talked about. Did you install a new anti-theft system? Write it down. Is your kid on the honor roll at Evanston Township High? Write it down. Are you a member of the University of Illinois Alumni Association? Write it down. Create a master checklist. Third, and this is the kill shot, you get competing quotes. Not 1, not 2, get 3. Go to Progressive, Geico, State Farm, whoever. And here is the critical part. You must get quotes for the exact same coverage you have now. Apples to apples. $100,000 in bodily injury liability on your current policy means you get a quote for $100,000 in bodily injury liability. This isn't about changing your coverage. It's about changing your price. Once you have those quotes, print them out. You now have a dossier. You have your current policy, your list of unclaimed discounts, and hard proof that other companies in Illinois want your business for less money. You are no longer just a guy asking for a discount. You are a highly desirable customer with documented, better offers. Now for step 2. The anchor. This is how you start the call. Your tone is everything. You are not angry, you are not complaining. You are a calm, informed, long-term customer conducting a review. When the agent answers, your opening line is not, "Why is my bill so high?" Your opening line is something like this. "Hi, my name is Mark, and my policy number is 12345. I've been a happy customer for 8 years, and I'm just doing my annual policy review to make sure I'm still getting the best value. I have a few competitive offers in front of me, and I was hoping you could help me see if we can close the gap, because my first preference is to stay with you." Do you see the difference? You've complimented them. You've established your loyalty. You've anchored the conversation around the fact that you have other better offers. You've framed the entire call as them helping you stay, not you begging for a handout. This immediately shifts the dynamic. You've taken control. The agent now knows you're not just fishing. You've done the work and you're prepared to walk. Their goal is customer retention, and you've just made it clear that they are now in danger of losing you. This leads directly to step 3, the most important part of the conversation. The discount gauntlet. This is where you use your dossier. The agent will likely start with a generic offer, maybe a small 5% loyalty discount. This is where amateurs say thank you and hang up. You are not an amateur. You will say, "Thank you, I appreciate that. Now let's go through my discount checklist to make sure we haven't missed anything." And you pull out your list from step 1. You go through it line by line. "I see I'm getting the multi-policy discount, which is great. I also see my son, who is on my policy, just made the dean's list at Northern Illinois University. Can we apply the good student discount?" They'll say yes. "Great. Also, my wife now works from home 5 days a week, so her annual mileage has dropped from 15,000 to under 5,000. Let's update that for the low mileage discount." You are not asking if there are discounts. You are telling them which ones you qualify for and instructing them to apply them. Now, what about that problem we ended the last part with? The agent says, "I'm sorry, you can't combine the new good student discount with your existing safe driver discount." This is a classic roadblock. Your response is calm and strategic. You say, "Okay, I understand they can't be stacked. Can you please do me a favor and run the numbers both ways? Let's see which single discount, or which allowable combination, results in the lowest possible premium. Does the 20% safe driver discount save me more than the 15% good student discount combined with the 10% low mileage discount? I'll hold while you calculate the final price for each scenario." You see what you did there? You didn't argue. You made them your partner in solving the puzzle. You've shown them you understand the rules, and you're simply asking them to find the optimal configuration within those rules. This level of detail shows you are a serious customer who knows the game. You're not just asking for money off. You're asking for a detailed policy optimization. This is a level of scrutiny they rarely encounter. Finally, step 4. The final play. You've gone through the gauntlet. They've applied a few new discounts, but there's still a gap between their best offer and that killer quote you got from another carrier. Let's say your current company has come down to $150 a month, but your printed out quote from a competitor is $120 a month for the exact same coverage. That's a difference of $360 a year. That's real money. Most people give up here. You won't. This is where you make your final play. You say, "I really appreciate all the work you've done. You've been very helpful. It looks like with all the available discounts, you've gotten the premium down to $150. As I mentioned, I have a written quote here from Allstate for the identical coverage at $120. That's still a significant difference. I've been with you for 8 years and have never had a claim. Is there a customer retention specialist I could speak with to see if there's any other loyalty pricing or discretionary adjustment you can make? I would much rather stay, but it's very difficult to justify paying an extra $360 a year for the same product." Listen to those keywords: customer retention specialist, loyalty pricing, discretionary adjustment. This is insider language. The frontline agent often doesn't have the authority to go further, but the retention department does. Their entire job is to prevent customers like you, loyal, informed, and with a better offer in hand, from leaving. By asking for them specifically, you are escalating the negotiation to the one person whose job it is to give you what you want. This is your checkmate move. 9 times out of 10, they will either transfer you to that department or suddenly find one more discount they can apply to close the gap. Using this 4-step method, the dossier, the anchor, the discount gauntlet, and the final play, you are fundamentally changing the power structure. You're transforming from a passive bill payer into an active, informed partner in your own policy. You're not relying on hope. You're relying on a strategy that can and will save you hundreds, if not thousands of dollars over the life of your policy. You now have the complete playbook for negotiation. But there's a catch. Huge one. You can execute this entire plan perfectly, get the rock bottom rate, and save a fortune, only to have it all wiped out by one tiny, overlooked error during your next renewal. It's a trap that millions of people fall into. A mistake that not only negates all your hard work, but can actually get your rate jacked up higher than it was before. And that single critical mistake is exactly what we're covering in the final part of this series. It's the mistake of timing, the single most catastrophic, yet common, error you can make when switching car insurance is canceling your old policy before your new one is fully, officially, and bindingly active. Sounds simple. Sounds like common sense. But in the excitement of saving hundreds of dollars, people get eager. They want to sever ties with their old, overpriced company as fast as possible. So they call and say, "Cancel my policy effective midnight tonight." Then they sign up for the new one, which starts tomorrow. They see a clean break. The insurance world, however, sees a red flag the size of a billboard. They see a gap, a lapse in coverage. Even if that gap is only for 12 hours or 6 hours, or a single hour while the clock ticks past midnight and the new company's servers process your payment, to the underwriting algorithms, a lapse is a lapse. And a lapse in coverage is the cardinal sin of auto insurance. It instantly relabels you. You go from being a responsible, continuously insured driver to a high-risk client. That fantastic quote you just got? The one that was going to save you $70 a month? It was based on your history of continuous coverage. The moment that continuity is broken, the quote is invalid. Let me paint a picture for you. Meet Sarah, a nurse from Peoria. She's been with the same big-name insurer since she was 16. She's turning 30, has a perfect driving record. And after watching a video just like this, she realizes she's probably overpaying. She spends a weekend getting quotes. She does everything right, compares apples to apples, checks liability limits, reads reviews. She finds a fantastic deal with a newer tech-focused company that will save her over $800 a year. She's ecstatic. On Monday morning, she calls her old insurer. "I'd like to cancel my policy, effective at the end of the day today." They try to keep her, but she stands firm. She gets off the phone, feeling proud and financially savvy. She then goes online, pays for her new policy, and sets the start date for the very next day, Tuesday. Perfect. Seamless. or so she thinks. What Sarah doesn't know is that her new company has a standard 24-hour underwriting review for new policies. Her payment is processed, but the policy itself isn't officially bound or active until a human underwriter signs off. Tuesday morning, the underwriter, let's call him Dave, pulls up her file. He runs a standard industry report, and a bright red alert flashes on his screen. Lapse in coverage. The system shows her previous policy was terminated at 11:59 p.m. on Monday. Her new policy isn't active yet. For the last 10 hours, Sarah has been, in the eyes of the entire insurance industry, driving uninsured. Dave is now forced to recalculate her rate based on this new critical piece of information. She is no longer a preferred risk client. The system spits out a new number. That $800 a year savings? It evaporates. In fact, the new quote is now $150 more per year than what she was paying with her old company. She gets an email an hour later, not with her new insurance cards, but with an updated quote and a notice that her rate has been adjusted due to a recent change in her insurance history. Her heart sinks. All that work, all that excitement gone. And worse, that lapse is now permanently on her record for the next 3 to 5 years, meaning every time she shops for insurance, she'll be penalized for it. This isn't a scare tactic. It's the cold, hard reality of how the system works. In Illinois, the state takes continuous coverage very seriously. Your old insurer is required to notify the Secretary of State when your policy is terminated. The state's electronic monitoring system will then look for a new active policy. If it doesn't find one immediately, the letters start coming. First a warning, then potential fines, and eventually a suspension of your vehicle registration. You could be pulled over for a minor traffic stop and end up with your car being towed and your license suspended because of a simple timing mistake. So how do you avoid Sarah's fate? How do you switch policies like a professional, guaranteeing you get the rate you were quoted and protecting your record? You follow the overlap and confirm method. It is the only way. Step 1. Go through the entire application process with your new chosen insurer. Get the final approved quote. Step 2. Pay for the new policy. Do not just get a quote. You must complete the transaction and make the first payment. Step 3. This is the most important step. Wait until you have the official policy documents in your hands or in your email inbox. I mean the full declaration page and most importantly the official state-approved insurance ID cards. This is your proof. It means the policy isn't just pending. It is bound, active, and legally in force. Step 4. Check the effective date and time on those new documents. Let's say it starts at 12:01 a.m. on June 1st. Step 5. Only now, after you have proof of new coverage, do you contact your old insurance company to cancel. And when you call them, you don't tell them to cancel it today. You tell them to cancel it effective 12:01 a.m. on June 1st, the exact moment your new policy begins. Or, to be absolutely bulletproof, you can tell them to cancel it at the end of the day on June 1st. Yes, that means you'll be double insured for 24 hours. You will pay for 2 policies for 1 day. This might cost you a few dollars, the price of a cup of coffee, but that few dollars is the best insurance policy you can buy against administrative errors, computer glitches, or processing delays. It guarantees with 100% certainty that there is no gap. Now there's one more layer to this. The cancellation call itself is a minefield. You need to handle it correctly. When you call your old insurer, you will almost certainly be transferred to a retention specialist. This person's entire job is to keep you from leaving. They are highly trained, and they have tools at their disposal. They can offer discounts, change coverages, and question the deal you got. The mistake people make is treating this like a negotiation. They say, "Hi, I found a better rate with another company." This is an invitation. It opens the door for the retention specialist to ask, "Oh really? How much did they quote you? Are you sure it's the same coverage? You know, those new companies don't have the same claims service we do." They will try to plant seeds of doubt and create confusion, hoping you'll just give up and stay. Here is the script for the perfect cancellation call. It is polite, firm, and non-negotiable. You get on the phone and say, "Hello, my name is," your name, "and my policy number is," your policy number. "I am calling to cancel my policy. I need the cancellation to be effective on date and time your new policy starts." That's it. They will ask why. Do not give them a reason. You are not obligated to. The most powerful phrase you can use is, "I've already made my decision and have secured other coverage." If they persist, just repeat a version of that phrase. "Thank you for the offer. but I've already made my final decision. I appreciate your time, but my new policy is already in place, and I just need to process this cancellation. Don't name the new company. Don't tell them the rate you got. You give them no ammunition. Your decision is made. You are not calling for advice. You are calling to give a directive. Before you hang up, you make one final request. Please send me a written confirmation of the cancellation, including the effective date and time, via email or mail. This is your receipt. This is your proof that you closed the loop. And that's it. That is the final critical piece of the puzzle. Over the last 10 parts, we've journeyed through the entire landscape of Illinois auto insurance. We've demystified liability limits and uncovered the power of stacking UM/UIM coverage. We've explored the future with telematics and usage-based insurance. And we've dug deep to find every last discount you're entitled to. We've armed you with the strategies to shop like an expert and the knowledge to build a policy that truly protects you. But all of that knowledge, all of that hard work, is only as good as your execution of this final step. Because getting a great insurance rate is one thing. Actually keeping it and making the switch without shooting yourself in the foot is another. This series was designed to do more than just save you money. It was designed to give you a sense of control over an expense that feels uncontrollable for so many. It's about turning confusion into confidence. The power is now in your hands. You have the blueprint. You know more than 99% of the drivers on the road about how this system truly works. Your journey doesn't end with this video. It begins. Your first step is simple. Find your current policy's declaration page. Just look at it. See what you're paying for. That's the first step on the path to taking control. Thank you for investing your time with me through this series. I hope it has been as valuable for you to watch as it was for me to create. Drive safe, stay protected, and never settle for paying $1 more than you absolutely have to.